This year, the investment environment has changed dramatically. As we face high inflation, reversing central bank policies, supply chain issues, and the war in Ukraine. With me in the finews studio to talk about what investors need to keep in mind and which opportunities are available in fixed income is Simon Lue-Fong, Head of Fixed Income at Vontobel. Hello, Simon.
Hello, Jade.
So there's a very uncertain environment that we've just described. Can you tell us about the main risks in this context?
Oh, it's been a terrible environment for fixed income. But the good news is, and actually it's a little joke that people in fixed income are saying, is that the income is back in fixed. So yields have gone higher, spreads have gone wider, there's more value. But there are still risks out there. And three of the risks are inflation. We're not sure if that's peaked yet. Geopolitics, of course, the invasion of Ukraine, the war in Ukraine is still going on, so it's not ended yet. But probably the worst risk for me is the potential for a slowdown.
Potential for a slowdown. So we're talking about high inflation and a growth slowdown. What is the main problem around stagflation? Why are people so worried about it?
Yes, I mean, if we get high inflation, which would put central banks in a difficult position with growth slowing, so then they're going to have to choose, do they try and support growth or do they fight inflation? That becomes a very dangerous area. And perhaps actually one way to describe how bad this could be, and we can all measure this, is what I like to look at is the misery index. And the misery index is literally where you just add inflation to the unemployment rate. In the 50s and 60s, that's when we were the least miserable. We were sitting in a range, if you added those two together, somewhere between 5 and 10. The worst periods where we did have stagflation in the 70s and early 80s, and it was sitting above 20. And now we are rising quite sharply, and we're at about 12. So we could get more miserable. And when we're miserable, by the way, what happens is that asset returns tend to be low, both in equities and fixed income.
Moving on to the brighter side of things, where are the opportunities in this environment?
Well, I would say the first opportunity is the fact that because yields and spreads have risen, therefore the reinvestment rate in fixed income is much better. And I think that's really powerful given that we had come from a world of very low rates. I think the second area, and if we maybe break that down between the developed market world and the emerging market world, is in the developed market world, there are opportunities in such areas as banks and insurance, in the telecommunication area, as well as the staples. And I think that the balance sheets, the leverage ratios and interest rate coverage ratios are very good. So we're sort of starting from a strong basis here. I think on the EM side, what we have to look at is perhaps all the commodity producers provide an opportunity, but in particular, as a percentage of GDP, it's really the oilers. So that's the oil exporting countries, everywhere from the Gulf way down to Ecuador.
And in this environment that we've just described, would you say that we need to take macro considerations more into account than in the past?
I think that we should always, and I think investors always do take the macro into consideration. What we have here, though, is we have a change in regime in a way, that we were going from that low inflation return where the markets, some people said, were rigged by the central banks, to one where they're kind of unrigging it, I guess. So of course we need to pay attention to that, because at the end of the day, the macro provides the setting for the playing field that we all play on.
Sri Lanka defaulted this year. Do you see risks of other countries defaulting?
In the emerging market world, we probably have around 2 others which could default in the next, let's say, 12 months plus. El Salvador, Tunisia, I think those are ones that we have to potentially watch. That would take the default rate of the expected defaults in any case to around maybe 4% or so. But actually, I'm not worried about the expected defaults, actually. What one needs to think about are the unexpected ones, which by definition are hard, but that's why I definitely think that at the moment it's an active investor's paradise, because there is going to be a lot of differentiation out there between both countries and sectors and individual names.
And where can investors find safe havens?
Safe havens, that's an interesting one. I think in itself, bonds are a safe haven. So if we're really going into a difficult world, then just owning bonds, especially government bonds, and especially because now they have higher yields, is definitely going to come into play. So I think that bonds can come back into fashion, given the fact that, as I said, yields are higher. The other area that you could find safe havens, though, is that because the world is changing from a geopolitical angle, you're going to now start to see the world change a little bit. So before, everyone was going to the lowest sort of cost producer. I think all of that is changing, and people are going to look for security of their supplies, and they're going to look logistically, geographically, for countries that are near them to supply those. So I think there's a lot of nice games here between winners and losers that an active investor can benefit from.
Fantastic. Thank you, Simon, so much for speaking to me today.
Lovely to speak to you, Jade.
Thank you.